Let's talk about liabilities. It's a term you'll hear a lot when dealing with finances, whether it's personal or business, and understanding it is crucial for building a strong financial future. So, what is a liability? Simply put, a liability is something you owe to someone else. It's a financial obligation. Think of it as the opposite of an asset, which is something you own that has value. Liabilities represent your debts and what you need to pay back. Now, why is this relevant, especially for a U.S. audience? Well, debt is a big part of American life. Mortgages, student loans, car loans, credit card debt, these are all common liabilities. Understanding how these obligations impact your overall financial health is key to managing your money effectively and achieving your financial goals. Ignoring your liabilities can quickly lead to financial stress and even ruin. Let's break down how liabilities work with some simple examples. The most common example is a loan. Let's say you take out a $20,000 car loan. That $20,000 is a liability. You owe that money to the bank or lending institution, and you're obligated to pay it back, typically with interest over a set period. Each monthly payment you make reduces that liability. Another common example is a mortgage. If you buy a house for $300,000 with a mortgage, that $300,000, minus any down payment you made, is a liability. You owe that money to the mortgage lender. Again, with each mortgage payment, you chip away at that debt. It's important to remember that even though you own the house, you still have a significant liability until the mortgage is fully paid off. Credit card debt is another huge one. Let's say you charge $2,000 on your credit card. That $2,000 is a liability. Unlike a loan with a fixed payment schedule, credit card debt can be more complex, with varying interest rates and minimum payments. If you only make the minimum payment, it can take a long time to pay off the debt, and you'll end up paying a lot more in interest. Liabilities aren't always just loans or debts. They can also include things you owe in the future. For example, accrued expenses are a liability. Let's say you've received services from a contractor, but haven't paid the bill yet. That unpaid bill is a liability. Similarly, unearned revenue is a liability. If you receive a prepayment for a service you haven't yet provided, that money is a liability because you owe the customer that service. Let's look at a quick example combining assets and liabilities. Imagine you buy a car for $25,000. You pay $5,000 in cash as a down payment and finance the remaining $20,000 with a loan. Your asset is the car, worth $25,000. Your liability is the $20,000 car loan. Your net worth in this simplified scenario is $5,000, $25,000 asset, $20,000 liability. Understanding the difference between current and non-current liabilities is also important. Current liabilities are debts due within 1 year. This includes things like short-term loans, accounts payable, and the current portion of long-term debt. Non-current liabilities are debts due in more than 1 year. This includes things like long-term loans, mortgages, and bonds payable. For businesses, liabilities are recorded on the balance sheet. The balance sheet follows the fundamental accounting equation. Assets equals liabilities plus equity. This equation highlights the relationship between what a company owns, assets, what it owes, liabilities, and the owner's stake in the company, equity. Now, why is managing your liabilities so crucial? Well, high levels of debt can hinder your ability to save for the future, invest, and achieve your financial goals. It can also impact your credit score, making it harder to get approved for loans or credit cards in the future. Conversely, managing your liabilities effectively can improve your credit score, lower your interest rates, and free up more money for other financial priorities. Strategies for managing liabilities include creating a budget, prioritizing debt repayment, consider methods like the debt snowball or debt avalanche, and consolidating debt. Debt consolidation involves combining multiple debts into a single loan with a lower interest rate. Let's recap. A liability is a financial obligation, something you owe to someone else. Common examples include loans, mortgages, and credit card debt. Liabilities are recorded on the balance sheet and are crucial to understand for assessing your overall financial health. Managing your liabilities effectively is vital for achieving your financial goals and building a secure future. Being aware of current vs. non-current liabilities provides a more comprehensive picture of your financial obligations. Prioritizing debt repayment and utilizing strategies like consolidation can significantly improve your financial well-being. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.